AT&T has a 7% dividend, but is it safe? Let's find out. The first thing that we need to do to measure if a stock has a good dividend or not is to crunch some numbers. What we want to do here is we're just going to go ahead and open up a new tab, call it dividend stocks, window, ticker symbol T. Now that we have this note open, let's just go ahead and get started. AT&T dividend. Perfect. All right, cool beans. We got that going. What we are going to look at. So the first thing that we need to know when we look at a stock that has a very high dividend and a lot of debt is it's not about the total amount of debt that the company has, but how that debt is structured and if they have the cash flows to support that debt and service it or not. And the most important thing about servicing the debt and the way it's structured is that we have a margin of safety. Here's the easiest way to discover how much leverage an investment has. You open up the company's balance sheet and you immediately go to their total assets. AT&T's case, they have $400 billion in total assets. And you're going to take that number and you're going to put it right over their shareholders' equity, which in this case is $100 billion. Okay, so what we've done here is we've jotted down that AT&T has $400 billion in total assets and they have shareholders' equity of $100 billion. So we can automatically say they have a leverage ratio of 4-to-1. So what this ratio does is it gives us an idea as to how leveraged the company is. Now, anything above a 2-to-1 ratio tends to be a bit more leveraged than what you would want, but it's completely dependent on the company's earnings power and their competitive edge. AT&T's leverage ratio is 4-to-1, which seems a bit high, but we don't have an idea as to how good they are at generating cash flows, so we're going to have to keep digging. The next thing that we can check on is the company's debt to equity ratio, and what this does is it lets us know how much of the company's assets are financed by debt. Let's see a debt to equity ratio under 1, and anything over 2 becomes a little bit more risky. But again, the key here is how good are those assets at generating cash flows? So until we have that, we don't have a specific answer. Okay, so what we need to do is we need to find what the total debt is. AT&T has $13.75 billion in short-term debt, and AT&T has $142.1 billion in long-term debt. And we already know that AT&T has $100 billion in equity. What we can see here is that AT&T has $155 billion in total debt and $100 billion in total equity, which gives it a debt to equity ratio of 1.558. That's a little bit high, but we still don't know how these assets are performing and generating cash. Now what we're going to do is we're going to check on AT&T's interest cover. And what this is it tells us how easily AT&T can pay off their debt with their cash flows. Now, an important point here is that Ben Graham, Warren Buffett's mentor, always suggested that companies should have an interest coverage of over 5. To find interest coverage, all we have to do is find the operating income and divide it by the interest expense. We pull up the income statement, we find operating income. We can see here that AT&T has generated $23.3 billion in operating income. And if we scroll down a little bit further, we can see that the interest expense over the last year is $6.19 billion. AT&T's interest coverage is a little bit low at 3.76. So what does that mean? Well, it means that AT&T might not be in the best shape, but let's check out one more thing before we put the nail in the coffin. The last thing that we're going to check on is the effective interest rate that AT&T is paying on its debt. This is the percentage that the company is actually borrowing money at. Finding this out is pretty straightforward. All we have to do is find the interest expense that they're paying and the total debt that the company has. We find the interest expense on the income statement. AT&T's interest expense is $6.19 billion. And we find the total debt on the balance sheet, which we have already discovered that it is $155 billion. Remember at the beginning of the video where I said it doesn't matter how much debt the company has, but more so how that debt is structured and how good that company is at generating cash flows to pay off that debt? Well, here's why. When that company doesn't have the cash flows to service that debt and they have to go out and get new debt and interest rates are going up, that debt is going to become more expensive. This has a double whammy effect. First off, it means less money for shareholders, And second, it means less money that can be reinvested back into the business. Now, there are two things that are going to help us determine if AT&T is worth the risk for that 7% dividend yield. The first thing is something I like to call cash build. Cash build is net income plus depreciation minus capex and minus dividends. This formula is going to tell us exactly how much cash our company is building. Now, last year, AT&T had some big one-time losses. I'm not going to include them in the net income for this number. Keep in mind, those losses are very real to shareholders. Net income with those losses removed is $17.5 billion. The company had $18.1 billion in depreciation, and it had $20.7 billion in capex. We can see here that AT&T paid $8.1 billion in dividends. I'm just going to note that I'm adding back the share repurchases in this formula because that's money that's going out of the business. And if AT&T stock is not undervalued, that's a very bad idea. Now that we've crunched those numbers, we can see that AT&T's cash build is $6 billion, which is only about 3.85% of the debt. Return on invested capital is going to be the closest thing to your long-term return in AT&T stock. Here's how the formula works. You take your cash flow and you divide it by your equity plus debt. AT&T has cash flows of $15 billion. They have debt of $155 billion. And they have equity of $100 billion. That means that the return on invested capital is about 5.8%. AT&T doesn't have enough margin of safety for me as an investor. Here's the best criteria for finding high dividend yield stocks. First, little to no debt. The highest dividend yield stocks tend to have a ton of debt. To build an elite portfolio, find high dividend yield stocks with no debt. 2, free cash flow positive for at least 5 out of the last 10 years. Preferably more. 3, return on invested capital of greater than 10%. This number is going to be a good gauge of what your long-term returns are going to be. If you want a list of 5 stocks that fit this criteria, DM me Dividend.